Wait. We're in a recession, inflation is running wild, gas prices are going through the roof, people can't even get petrol for their cars, and you are telling me to invest in growth companies? Man, it makes absolutely no sense to invest in the stock market right now. Wait a minute, makes no sense. Exactly. Buy the dip. Hello everyone, welcome back. My name is Dan, and in this video I will be showing you divergence, how to spot it, which indicators you should be using to find divergence, and how to use it to your advantage, and how to implement it in your system in order to make profits in the financial markets. I will start by telling you what is divergence, and let's read the definition. So, divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or is moving contrary to other data. Divergence warns that the current price trend may be weakening and in some cases may lead to price changing direction. So what does that mean? That means that basically the indicator will be showing you one thing and the price action will be showing you a different thing. And that means that they are diverging, all right? And there might be a short-term or a long-term trend reversal. And of course, you should try and spot those trends reversals early, and in order to give you an edge or an advantage over other traders and make some money. But of course, you shouldn't be relying only on trading indicators because they are not so accurate. They're just mathematical representation of a past price movements, and that's why they are called lagging indicators. Okay, that's where the terms come from. So they are lagging. However, every tool in trading that can give you some kind of an edge is a good tool, as long as it's back tested and as long as you seen that it actually works. Now let me show you how the divergence looks on the graphical. So this is a price movement and this is an indicator, MACD in this case. So the price moves up, indicator moves up. The price goes down, indicator goes down. Price goes up again, indicator goes slightly up again. Price goes down, indicator goes down. Price goes up and the indicator started going up. Okay, but you see that they're represented very differently here. So the indicator is showing you that it's going downwards all the time and the price action is actually going upwards, okay? This is called divergence. So basically it is a visual discrepancy between the price movement and the indicator. Now there are two types of divergences. There are regular divergence and hidden divergences. Now let's move to the PC and let me show you how the regular bullish divergence looks like. So the indicator is showing you higher lows and the price action is showing you lower lows. This is regular bullish divergence, okay? And it means that the trend reversal to the upside, that's why it's bullish, is possible, which actually happened in this occasion. You see we had a consolidation, we were gathering momentum, and boom, we went and had a strong impulse to the upside. So if you traded it here, if you took a position right over here in this area, you would make some nice profits. The next type of divergence is regular bearish divergence. Indicator is creating lower highs, okay, and the price action is creating higher highs. That represents a possible trend reversal, in this case to the downside, which actually played out similar as the previous example. So basically we had a consolidation area and then boom, we went to the downside. And if you actually gathered a position right over here and if you shorted it, you would make a nice bunch of points and a nice bunch of profits. So to review it, regular bullish and bearish divergences represent a possible trend reversal, okay, from the current trend that we are at. So you are looking for those cracks, as I've said in the previous video, and trend weaknesses in order to spot trend reversals early and use them to your advantage. Now let's move on to hidden divergences. The first type of hidden divergences we'll be going over is hidden bullish divergence. In hidden bullish divergence, the indicator is creating lower lows and the price is creating higher lows. So we have an uptrend, okay, and we have a short-term downtrend. So on the first weakness of that short-term downtrend, we will be taking opportunity to trade it back to trend, and which is long. And the signal is giving us right over here a sign to go long. So if you took a position right over here, you would have a nice long position and some nice profit. And the last hidden divergence is hidden bearish divergence. In hidden bearish divergence, the indicator will be creating higher highs, but the price will actually create lower highs. So we are in a downtrend and a short-term uptrend, and the indicator gave us a signal that this short-term downtrend is actually weakening and that we should take a trade back into trend, which you could have done right over here at this accumulation phase and go down into trend and make some money. A main difference between hidden divergences and regular divergences. Hidden divergences are basically trend continuation, and regular divergences are giving you signals for trend reversals. You can find divergences on other indicators other than MACD, and another one that I'm using personally is RSI. I would also recommend stochastic. Stochastic is also good for trading divergences and it gives a lot of good signals. I will give you an example on how divergences look on RSI. Over here we have regular bearish divergence, okay? So the price is creating higher highs, but the indicator is showing lower highs. And you can see how edgy and pointy RSI is in comparison to the MACD. And the RSI is actually way more sensitive than the MACD. Even though both indicators you can set them up differently and you can use different values in order to calculate and give you a little bit more sensitivity. However, I would stick to default settings because that's what most people are using, default settings, and you want to see what other people are seeing. So as you can see, the main difference is that the RSI is a little bit more pointy and edgy than the MACD that's kind of round and creating some waves. Okay, that will be all for today's lesson. It's a short one. However, I hope that you learned and understood how to implement divergences together with other stuff and tools to your trading in order to make some profits. And smash that like button, subscribe to the channel. Many new things are coming. There's a lot of information to be covered. In the next video, I will be going over how to create your own personal algorithm. And this is one of the most important things that you will need to know. Actually, everything is important, right? You need to combine everything together, but all these things do not work well one without another. So stay tuned for more, and I hope you have a great day.